Hello viewers, welcome to the topic of ratio analysis from this video. After this video, we are able to find the answers to the questions such as what is ratio? Why does financial accounting require ratios? Who are the stakeholders of a business interested in financial ratios? And what are the types of financial ratios? To see the basic meaning of ratio, it is defined formally as the indicated quotient of two mathematical expressions. Financial ratios are among the best known and most widely used tools of financial analysis. An operational definition of a financial ratio is the relationship between two financial values. Financial ratios become meaningful to judge financial condition and profitability performance of the company only when there is a comparison. Hence, the financial ratios are highly significant to fulfill the following requirements: analysis of financial statements, and it helps in understanding the profitability of the company. So it's also used to analysis of operational efficiency of the firms, checking and maintaining liquidity of the firms, predicting business risks of a firm, and it helps in identifying the financial risks of the company and for planning and future forecasting of the firm, and finally to compare the performance of the different firms. Now, let's see the different kinds of stakeholders concerned. First, owners of the company, managers, and employees are part of internal stakeholders of a company. These players are internally connected to the organization and they are interested to find the status of liquidity position of the company. Owners are concerned about assessing profits for the well being of the company, whereas managers focus on financial targets and analyzing the achievements with the help of financial management functions, and finally, employees look for good status to meet their career and personal aspirations. And there are shareholders, suppliers, consultants, competitors, customers, and advisors who externally connected to the organization. For instance, the shareholders constitute to the capital and suppliers constitute to the base material. So, they are concerned about the ratios of return on investment. Whereas the players like mass media and network, banking and finances, local customer groups, tax authorities, government, and community at large are considered as external stakeholders of the company, as they are indirectly connected to the company, so they are interested in the finance aspects of performance, long term planning, and crisis management. Coming to the classification of ratios, they are primarily divided into four categories: liquidity ratios, solvency ratios, activity ratios, and profitability ratios. Current ratio and quick ratio are considered as liquidity ratios, whereas debt equity ratio, interest coverage ratio, debt to total funds ratios are part of solvency ratios. And activity ratios consist of stock or inventory turnover ratio, fixed assets turnover ratio, working capital turnover ratio, and debt turnover ratio. And finally, gross profit ratio, net profit ratio, earning per ratios are part of profitability ratios. And let us keenly discuss liquidity ratios in our next session. Hope we answered all the questions. Thank you.